Let's say there is a person who have $20,000 and says to his friend that he is going to buy a new car. But his friend says that he too have $20,000 in his account, but he is going to invest in stock market so that in the future he will get the returns from the companies from which he can buy a new car, and he can also keep his capital too. Exactly like how that stock market guy said, after 2 years, the car's value got depreciated and its current worth is around $12,500. But on the other side, the person who had invested in the stocks have his capital grown 300% and he has around $60,000 as of now, and he have also got dividends 6 times in the span of 2 years as well. Person A wanted that instant gratification, but person B decided that he will invest so that the money he invested will grow in few years, and by investing he would get the dividends twice a year, also the profits from the share, and also he can keep the capital too. As you can see, there is a very little difference in the mindset which will make someone poor and will make someone rich. Guy going for the car had a very poor money management skills and is not going to attain the financial freedom, and he will stay poor. But on the other side, the person who said he will be investing in stock market will have the financial freedom because he has a very good financial management skills and he will become rich. This example tells you what is investing and the magic of investing. Investment can make you rich, and that is why knowing about investment is very essential. This poor mindset people have never came to know about what is investment, compounding the money, financial freedom, and a lot. It's because that is something that they have been never taught in their school. But in this channel, we are going to give you the knowledge, ideas, and the direction that school had failed. So keep following this channel. We are going to give you videos about what is investing, what are the investment methods, how to invest in stock market by analyzing the stocks, and much more about financial stabilization. And by the way, we have given a video about share market too. I'm sure you want to know about it. Link is in the description. First we will see what is investing. Investing is purchasing an asset or buying anything with your financial resources as an endeavor to achieve later benefits or earn more assets or make more money out of it. You have now got to know why you should start to invest and what is investing. But now comes another question, how to invest. Before you invest, you should want to make sure certain factors. The number one thing, become debt free and make sure you have no liabilities. Point 2, investing with a very small capital also works, and for investing, not always a large capital is necessary. Point 3, know the risk before you invest. Coming to the point 1, why you should be debt free. Because if you are not debt free and you are also investing, now you have more liabilities than you had earlier. But if you are earning more than your debt, then make sure that you pay all the debt first, and then also you make sure that you invest a very small amount so that you can manage for your necessities too. Coming to the point 2, investing with a very small amount is totally okay. If you are poor and you are stating the reasons that you don't have money to invest, then you will stay poor. But even though if you are poor, but still you are reducing the unwanted or luxurious expenses from your life and you start to invest, and this effort will make you rich one day. Coming to the point 3, why you should know the risk. But before knowing that, we want to know about what is inflation. Inflation, in simple words, is the decrease in the purchasing power of money. If the money supply grows bigger than the size of the economy, the unit value of the currency diminishes. In other words, its purchasing power falls, and this can strongly impact the price of the goods. If the price of the goods went down, the companies that run making them also falls, and the stock of those companies also falls. Also, if there are any global sentiments such as during war or when the interest rates are decided, when the ruling party of the country changes, the stocks see very high volatility. So investing in stocks have definitely financial risk in it. So if you are going to invest in stocks, then make sure you are ready to risk 1% or 2% of your capital, and if the invested amount goes beyond that risk percentage, then make sure you don't hold them anymore. And this is why knowing the risk is a very important thing to know before investing. Nobody gets 100% win in stocks. It's all about learning from the mistakes. Knowing the right way and right time to invest your money will do it for you. Now, how much can you invest? If you have a very big capital, then you can invest in buying land or you can buy properties. But if you don't have the capital for the above, then it is better for you to invest in mutual funds, stocks, government bonds, and there are other few. investing in stocks is a better idea because when you invest, the price of the stock goes up when the company goes up. The companies, when they make profits, they pay you dividends as well, and they also give you bonuses sometimes. Definitely risk comes along with it. So as we have seen earlier, keep a certain amount of risk along with it. We will also see a video of risk management in the future. You have come to know that investing in stocks is risky and you don't want to invest in stocks. Then where else can you invest? You can invest in index funds. What are index funds? You have no idea about what is index or indices? Then watch the previous video, the link is in the description. Index funds are investment funds that follow a benchmark index. We as a people with not much knowledge about investing in stocks can invest in index funds at one time or once a week or once in 15 days or even once in a month. With our invested money, those index funds make businesses and they invest them in stocks and make profit out of it, and they will give you a certain percentage of the profits to the investors. That means you don't have to directly invest in those companies, but rather you can invest in those funds and let them do the magic. For example, many funding companies invest in funds based on indices like Nifty 50, Nifty 100, S&P 500, Nasdaq 100, and there are many more. Let's analyze it even better. We will take Nifty 50 as an example. The Nifty 50 is an index that stands for the top 50 companies that are listed in National Stock Exchange. Based on this Nifty 50, there are many index funds such as ICICI Prudential, Nippon India, HDFC, and Infinity. The money you have invested in any of the Nifty 50 index fund grows when the company is listed on the Nifty 50 grows. And the companies listed in Nifty 50 are the top companies in India which are contributing to the GDP of India, has more trust among the investors. All of these individual index funds have different amount of proportion on distributing their investment money into those 50 companies. ICICI Prudential may have a different proportion of investing the investors' money in those 50 companies, whereas HDFC may have different proportions. So you can see all those index funds and analyze how much percentage they are investing in each of the companies that are coming under Nifty 50. If you don't know how to analyze it, you can ask a financial advisor. If you don't have a financial advisor, follow FinGuru. Let's say if an index fund has given top priority in its proportion of investing the money into your favorable stocks, then you can choose that fund as an investment method. When it comes to investing in these index funds, investing for a long period of time is favorable. Investing for 30 years instead of investing for 5 or 10 years is very profitable for you because the money keeps compounding. And as the money compounds, it only gives you a greater return if you hold them for a longer period of time. Not sure about compounding? We will see what is compounding in another video. Alright, you have known all of these. But now, from where you can buy those index funds? You definitely need a middleman to buy those index funds, right? You can start investing in funds from apps like Grow, Angel One, Zerodha, and there are many more applications for trading and mutual funds. You can also do it from Paytm, and there are also many individual net banking apps as well. Now, as you have seen this video, you definitely have an idea about how you can invest in stocks and indices. If you want any other investment ideas, then I can give it for you too. You can start a company of your own, you can invest in it and make it grow to generate your revenue out of it. It's an investment. Just like these, investment ideas are unlimited, but only if you know the right way to do it. By saying this, we have come to the end of this video, and I also wanted to tell you that I'm not a financial advisor. Everything you have seen in this video is for educational purposes only. Do not buy or invest in any of the stocks or indices that were shown in this video. Make your own analysis and ask your financial advisors before investing in any of it. For more contents about stocks, funds, bonds, make sure you follow and subscribe to our channel. More interesting videos about investments will follow you. If you had liked this video, make sure you give me a like. And if you want any specific topics that you want to know, then put it in the comment section so that I can make a video out of it for you guys. Thank you so much. Have a great day.